I'm here in Switzerland with Jim Rickards. Jim is well known to all of you, and we meet all over the world in exotic places very often. But today we meet in Switzerland, and it's a pleasure to have you here. Welcome, Jim.
Thank you, Egon. Thanks for inviting me. It's great to see you in Switzerland. We've bumped into each other in Sydney, Australia, Hong Kong, London, elsewhere around the world. So it's kind of fun to be in your home territory of Switzerland.
Yes, and this is the gold mecca.
Right.
Here we are standing in one of the biggest private vaults in the world. For security reasons, we can't be right in the middle of the gold, but we are surrounded by silver here. And we also have a gold bar, which we will talk about in a little while. Switzerland, as you know, is also the biggest refiner of gold, and not of silver, but of gold bars in the world. I mean, the majority of gold bars are produced here. So there's a great tradition in Switzerland. And we Swiss, we understand gold. Now, we went into gold, our company, and for our investors in 2002 in a big way. That's when gold was unloved and undersold at about $300 an ounce. All our investors have been sitting on it ever since. You know, at $300, this is 1 kilo, so this is about $40,000, but at $300 an ounce, already at that time, I had a fear what was going to happen in the world. And I forecast at that time that we would probably see at least 10,000 in today's money.
Right.
Now, what is your view about the price, first of all, in today's money or in the development, and why do you see something really happening in the gold market?
Well, there are a couple of drivers, Egon. It's a great question. One is just, good old-fashioned supply and demand, and you mentioned the role of Switzerland in the refining industry in general. I know people understand that gold has kind of been going from west to east. It's been leaving vaults in New York and London, going to vaults in Shanghai and elsewhere around the world, mostly in China. What people don't understand is that gold stops in Switzerland along the way. These older bars that were of a lesser purity, what people call scrap, which is jewelry, so-called doré from the mines. It comes to Switzerland, it gets refined into the new standard, which is 99.99% pure gold. Usually in exactly the kind of bar you showed here, these 1 kilo bars. This is the new gold standard. The old gold standard was the 400-ounce bar. The Chinese are setting a new gold standard exactly like this. So Switzerland's role is indispensable. When you talk to the refiners, what they're telling us is that they're seeing shortages of gold. They have demand. They have a waiting list for people who want to buy gold, countries and institutions, but they can't source the gold. They have to bring it in the front door before they can send it out the back door. One of the major refiners, we can't disclose the name, said they actually cannot get doré. Doré is what comes from the miners. It's about 80% pure. They turn it into 99.99% pure. They haven't shut down, but they can't get the doré. They're still processing scrap. But this gives you some idea of the shortages. So just on supply-demand fundamentals, the price of gold should be going up substantially, and it is. We've seen.
Can I just interrupt you there? You're talking about these kilo bars. We have seen in the statistics a lot of exports from the UK to Switzerland of gold. And, nobody knew that the UK was a big producer of gold. But of course, you've been telling now us why it's happened. There's the 400-ounce bars owned by central banks, owned by the bullion banks that are being broken down, being bought by China, and then broken down here to kilo bars, and then shipped.
That's exactly right.
To China and India also. India, for the jewelry trade, they also buy the 1 kilo bars.
Right, you mentioned, England is a major gold exporter. There's not much gold in England. You could dig the whole country up and not find any gold. But of course, the gold is coming out of the vaults. And interestingly, we have these silver bars, but they're kind of like dollar bills almost in the sense that they have dates and stamps and serial numbers on them. What we're hearing from refiners is, these gold vaults, it's on a LIFO basis, the last in is the first out. So the newer bars, maybe with dates of 2015 or 2014, they come out first. Refiners are telling us they're seeing bars with dates from the 1980s, meaning they're scraping the bottom of the barrel. They're taking the last bars out of the warehouse, melting them down, making them more pure, and sending them to China. So those shortages are already popping up.
When you say date, reminds me, we transfer a lot of gold from the banking system to private vaults for clients. And these big bars, as you say, also the gold bars, are dated.
Correct.
So, and we have had clients who bought gold many years ago, and the bank ships us. It takes a long time before we get shipment, and they ship us a new bar.
Right.
So the client had allocated gold and it wasn't there. They had to go and get it.
That's a breach of contract. It's one thing when you have unallocated gold. That means you have a paper gold investment. You want to convert it to allocated, then they're supposed to go get the gold. But if they told you they had allocated gold and you bought it 10 years ago or 20 years ago and they ship you a new bar, there's something wrong there. There's some kind of fraud going on. And this is just one more sign of trouble in the gold market. But there's something bigger than that, Egon. We're talking about basic supply and demand shortages, but there's a declining confidence in central bank money. I think of gold as money. Some people say it's a commodity, it's an investment. Fine, sometimes it acts that way, but I think of it as money, and it competes with other forms of money. So the dollar is money, the euro is money, the Chinese yuan is money, and gold is money. And what we're seeing is people are losing confidence in those other forms of money. When I see the dollar price of gold going up, I don't really think gold's going up. I think the dollar is going down. It takes me more dollars to get a quantity of gold. It's like when a doctor goes to see a patient, doesn't know if the patient is well or ill, they put a thermometer in your mouth and take your temperature. The dollar price of gold is like taking the central bank's temperature. It measures confidence in the central bank. Right now, that confidence is being lost. They can't get out of the problems they're in. They've proven that monetary policy will not fix the economy. It's only going to get worse. The dollar price of gold is going to go much higher. You know, Egon, when I pull a dollar bill out of my wallet, it's got a lot of markings on it, you know, stamps and serial numbers and all that. But I noticed these ingots we have in front of us, they have the same thing. They've got a lot of different stamps and numbers. Can you explain what all this means? I'm sure it's very significant.
Absolutely. Very important, these markings. So these are 1,000 ounce silver bars. That's 30 kilos. That is the standard delivery bar, it's called. 1,000 ounces. It is never exactly 1,000 ounces. These are all individual weights and have to be weighed individually. Mm-hmm. Just like the 400-ounce gold bars. They're never 400 ounces exactly. They're all individual weights. So that is, the weight is not on here, but what is on here is, first of all, the refiner. Here, this is Rickards, very well known, one of the top Swiss refiners. And then underneath here, you have 999.9. That's 4 nines. That's very significant. That is the highest purity you can really buy in silver. So that means it's 99.99% refined pure silver. So that is the highest quality silver you can buy in these type of bars. And also you have the date on here, 2016. So you know this is absolutely new silver from this year. Silver bars that are a few years old will get very dirty and black. So these are still beautiful, whilst, of course, gold bars always look the same.
Right. They don't tarnish,
big
right.
difference. And finally here, you have the serial number. So each bar has a unique serial number. So between the serial number and the refiner, you can always trace the bars.
So, Egon, I noticed there's one other marking on here right below the 99.99% purity. What is that mark?
So that's the assay stamp of the refiner. So that certifies that it is 99.99% silver.
Got it. So we got the refiner, the purity, the assay, it says Switzerland, the date, the serial number. The interesting thing is we have a number of bars in front of us, and I noticed this one is 67861, 67868. They're unique. Every one is different.
Absolutely.
And that's one way to. So if you say you have ownership of gold and you have a sponsor or a fiduciary or any firm that's holding the gold for you, you can actually get a serial number, and you know that's your bar.
Exactly. But what you always have to do when you buy gold or silver is to always buy through the LBMA chain of integrity.
Right.
So you should never buy it from a street vendor or from somebody you don't know, because now if you deal with that within that chain of integrity, you will never get a fake bar.
Right. And Egon, we have this gold bar here. Is this? I assume this is very similar in terms of the markings.
Yes, exactly the same. One exception. This is also produced by the same refiner, Greyerz. You can see that here, but it was produced for UBS, Union Bank of Switzerland, which is one of the oldest Swiss banks. So this was specifically made gold bars for them because they've been one of the biggest gold dealers in the world and in Switzerland. But otherwise, you see the same marking. But the big difference here, this is 1 kilo exactly,
right,
which is 32.15 ounces.
Right.
So this is not different weights as the silver bars. but we know that that is exactly 1 kilo.
And I see it has the purity. It says, again, 4 nines, gold, 1 kilo, etc. We don't want to store gold at UBS, but we don't mind if UBS makes the bar because it's a reputable, solid gold bar.
Exactly. So this is a bar that has been owned by someone at UBS and transferred to private vaults through us.
But it also has a unique serial number on it, so you can trace it. You can know this is your bar. You actually own that.
Absolutely.
This particular one, B35193. So this bar belongs to some individual, and there's no mistaking it.
So I know you've also talked about $10,000. What time frame do you see? And do you see that in today's money? Because people say, well, that's with inflation. I actually see it in today's money of the $10,000.
Right. I agree with that. Let me explain, first of all, where the $10,000 comes from, and then we'll talk about the timing of this. It's not a made-up number. I didn't pick a big number to get headlines or attract attention. You know, you don't need that. But it's actually the implied non-deflationary price. And what I mean by that, just take the money supply. So global M1, it's a technical name, but that's sort of money in checking accounts and money in people's pockets. Back it with 40% gold. And 40%, historically, that's a pretty high number. In the 19th century, England backed their gold supply or their money supply with 20%. In the 20th century, the US had about 40%. So take 40%. So take the official gold in the world, about 35,000 tons. Take M1, which we know, you can look that up in central bank websites. Take 40% of that and just divide, and you come out to $10,000 an ounce. That's the price that gold would have to be to restore confidence in the monetary system without causing deflation. You could have it at $1,000 an ounce, but that would be, you'd have to destroy the money supply to maintain the parity. That would be extremely deflationary. It would be a repeat of the Great Depression. Nobody wants that. Monetary experts understand this. So when I say $10,000 an ounce, you're right, that's in today's dollars. If you had a collapse of confidence in the dollar. Now, timing, it could happen tomorrow. I'm not saying it will happen tomorrow. It could be a year from now or 2 years from now. But the conditions are present. It's like an avalanche. You know, you see the snow building up. We're here in the Alps in Switzerland. The snow's building up. One snowflake comes along. It disturbs a few others. Eventually, it gains momentum and causes an avalanche. Could happen yesterday, today, or tomorrow. You don't know when, but you can see the conditions. The conditions for the collapse of confidence in paper money are already there. This could happen tomorrow.
No, I agree totally with that. And sadly, it is not, you know, you talk so much about not just the supply and demand, which of course we know that the futures exchanges, the interbank market, which is also all paper, and we know that there is only a fraction of physical gold for the amount of paper outstanding. At some point, that market will blow up. And of course, my view is that we will get hyperinflation. I don't think governments will actually be able to do, they have no tools available. Of course, printing money is not a solution.
Right.
If you print worthless pieces of paper, you're not going to create wealth.
Correct.
But they still will do it because they don't know anything else to do now. The US, in my view, will lower interest rates again and maybe go to negative one day, and the dollar will fall, and then gold will start going up. But so there's not only just the supply and demand situation, you have also most of the major nations in the world are bankrupt. And the financial system hasn't been mended since 2007-9.
Correct.
So therefore, you know, we could get to a situation when a lot of money is printed and you are getting into the hyperinflationary scenario. That, I think, in my view, to cover the 230 trillion debt outstanding in the world, which is not going to be repaid, in my view, and the derivatives of 1.5 quadrillion, whatever, there's a risk that a lot of money will be printed that will destroy the value of paper money and therefore be reflected in gold and silver.
That's absolutely right, Egon. In fact, a lot of money has been printed already, and we haven't seen that much inflation. So people say, see, you can print all the money you want and don't have to worry about inflation. But there's something missing in that analysis, which is you need two things to cause inflation. One is printing money, but the other one is what's called the velocity or the turnover of money. People have to, when they lose confidence in it, they're like, well, you can pay me in dollars, but I want to dump the dollars and, you know, and buy some gold or buy some silver, as the case may be. So it's when people start spending the money, dumping the money, trying to buy things because they think the price is going up, losing confidence. That's when prices soar, and that's a psychological phenomenon. So it takes two things. One is the money printing, which we've already seen, and we're going to see more. I agree with that. The other one is this loss of confidence when people dump the money. That's when the velocity or the turnover takes off. You can have hyperinflation almost overnight.
In my view, there's a high risk of that. So that's the first stage that, as I see it, in the next X years. You don't know. It could go very quickly. or it could take, but I don't think we're talking about more than 5 years in my view.
Well, I think that's right. The other thing I say to investors is, what are you waiting for? Maybe it is 3 years or 4 years. It may not be that long. It could be tomorrow. But when it happens, it's going to happen very quickly. It'll actually be too late to get the gold. I see a time, because of the fundamental supply-demand shortages, I talked to a major refiner. He said, Jim, if I didn't know you, if you were a new customer and you call up, I wouldn't return your call. If I didn't know you, if you weren't already a good customer, we don't want new business. We have more business than we can handle. We don't have enough gold that we can refine. So these shortages of physical gold are already popping up. When there's a buying panic, when there's hyperinflation, when this starts to take off, and it'll take off very quickly, people say, you know what, I don't trust my bank paper gold contract anymore. I call up and I say, give me the physical gold. There's only about 1 ton of gold for every 100 tons of claims. 99% of those people are going to find out they don't own gold. They're going to get a check in the mail, and they're going to miss out on the spike in prices.
That could happen faster than we would like, and of course it'll be a catastrophe for the world. The end game, if there is an end game, there is never an end game, because the world goes on. Whatever happens, the world will go on, of course, just maybe at a different pace and at a different standard of living than we've seen now. The last 100 years have not been real anyway. It's been created, fake prosperity created by central banks, and sadly that will come to an end. But after the hyperinflation, which is not going to solve anything, I still see a deflationary implosion. Because that's the only way that debt can disappear. Do you agree with that?
Well, there are 2 ways to get rid of debt. One is, three ways actually. One is growth, but we're not getting the growth, unfortunately. Printing money will not give you growth, so take that off the table. The other 2 are just default, like I'm just not going to pay you. It's an outright default. The other way is highly inflationary, which is, sure, I'll pay you the $1 trillion I owe you, but good luck buying a loaf of bread because I printed the $1 trillion. That's what the U.S. is going to do to China. By the way, that's one of the reasons the Chinese are stockpiling thousands of tons of gold. Yeah. They know the United States is going to inflate their way out of it. They can't dump those treasury bills that they own, or those treasury notes that they own, because the market's not that deep. So if you're stuck with the treasury notes and you know the U.S. is going to inflate them and you can't dump them, what can you do? Well, you can buy gold. And now you have a hedge position. You hope for a stable dollar, in which case the gold won't do very much. But you know the U.S. is going to destroy the value of the dollar, in which case the gold will go up. So you'll lose on the paper side, but you'll make it up on the gold side. I always say, if it's good enough for China, it's good enough for me.
Yeah. Well, I fear that any government paper will be worthless in the next few years, but we shall see. But in the meantime, this is not an investment. We both agree on that.
It's money.
This is money. This is real money. But it's also more, it's insurance.
That's right.
And it's the only insurance you can buy where you don't have to renew the premium every year.
That's right. And you also don't have to worry. When you buy insurance, I happen to be a lawyer in addition to being an economist. Yeah. And when I tell people they get insurance and they say, well, I'm protected. And I say, well, how good is the insurance company? Look what happened to AIG. It was one of the biggest insurance companies in the world, and they almost went bankrupt in 2008. So your insurance policy is only as good as the company that writes it. With gold, you have insurance, but there is no insurance company. You're holding the gold. You don't have to worry about who's standing behind it because you have it in your hands.
Right, as long as you keep it in places like this,
safe
outside
storage.
The system,
Absolutely.
Outside the bank.
Don't put it in the bank.
No.
Right.
Jim, it's a real pleasure to see you here.
Great seeing you. Thank you
so much.
Thank you.